The biggest danger to an economy is almost never the one people enjoy talking about. People want the threat to be dramatic. They want it to have a face. They want it to be political, emotional, loud enough to trend, and simple enough to explain in one sentence. I have lived too long around money to trust those instincts. The real danger usually sits somewhere much quieter. It lives inside the plumbing. It lives inside incentives. It lives inside the invisible arrangements that make markets feel easy right up until they do not. That is why, if you ask me what may be one of the most underappreciated risks of the American economy today, I would not begin in Washington. I would begin in Tokyo. I would begin with something so dull most people would never look at it twice. Japanese government bonds. Now that sounds ridiculous if you have never spent too much time inside financial history. The average person hears Japanese government bonds and thinks he is being dragged into some terminally boring lecture. He does not imagine mortgage rates in America. He does not imagine stock valuations in New York. He does not imagine corporate credit, private equity, commercial real estate, or the cost of money throughout the developed world. He imagines something far away and irrelevant. That is exactly why the subject matters. The most important structures in finance are often ignored because they are too boring to compete with the louder stories. The public wants the bubble, the election, the war, the latest technology, darling. It wants whatever can be packaged into a fight, a slogan, or a clean hero and villain narrative. But money does not care what is entertaining. Money cares what is connected. And for the last 30 years, one of the most important hidden connections in the world has run through Japan. If you want to understand it properly, you have to go back to the early 1990s, because that is when the chain was forged. Japan did not become a global financial force by shouting. It became one by breaking. That is the part younger investors often miss. They know Japan is a mature, wealthy country with advanced technology, strange headlines, efficient trains, and a reputation for order. They do not always understand what it felt like when Japan's great bubble collapsed and the country entered a long financial twilight. But I remember the way serious investors began talking about Japan after the bursting of the bubble. The real estate had become absurd. The equities had become absurd. The confidence had become absurd. And then the whole structure failed. When a nation passes through a collapse of that size, it does not merely lose money. It changes character. It changes how households think. It changes how companies behave. It changes what banks can do. It changes what the central bank believes it must do just to keep the machine from sliding backward. That is what happened to Japan. The country entered what people later like to call the lost decades. I have never liked that phrase very much because it sounds almost poetic, and there was nothing poetic about it. In financial terms, it meant something very plain: little real growth, very weak inflation. No satisfying wage engine, no broad feeling that tomorrow would naturally be larger than today. The animal spirits of a healthy capitalist expansion simply did not behave in their old way. That kind of environment creates desperation at the policy level. Central bankers are not mysterious creatures. When growth disappears and inflation vanishes, they do what central bankers almost always do: they cut rates. When that does not work enough, they cut more. When that still fails, they experiment. That is how Japan became one of the great laboratories of modern monetary policy. Rates went towards zero, then below zero. And when even that did not fully restore the kind of economy policymakers wanted, the Bank of Japan moved to something even more revealing. They began effectively controlling the long end of the yield curve. Yield curve control sounds abstract, but its meaning is brutal. It means the market's natural answer about the price of long. Term money has become so politically or financially unpleasant that the authorities decide to suppress it directly. That is an extraordinary thing when you stop and think about it. A normal bond market is a negotiation: supply meets demand, and price emerges. Yield curve control says the negotiation is over, the state has chosen the answer. Japan did that because it felt it had no pleasant alternatives, and once it did, Japanese government bonds became something close to financial dead space for large domestic savers. Yields were pushed down and held down. Home sovereign bonds ceased to offer attractive returns. For a pension fund, an insurer, or a bank trying to meet obligations over time, that was not a minor inconvenience. It was a structural problem. If you are a Japanese life insurer with a giant pool of assets and the domestic government bond market yields almost nothing. What are you supposed to do? If you are a pension fund with long-dated liabilities and your home market offers you little more than a decorative return, what are you supposed to do? If you are a bank or allocator trying to preserve margin, what are you supposed to do? You have two choices: accept almost nothing or leave. Japan left not emotionally, mathematically. That is the core of the whole story. The country did not become the world's silent financial giant because of patriotism, ideology, or some grand strategic speech. It became one because its own domestic monetary environment made the rest of the world look comparatively attractive. Once Japanese capital could borrow or fund itself at almost no cost, the global menu looked very different. U.S. Treasuries offered more. Mortgage-backed securities offered more. Global credit offered more. Equities offered more. Real estate offered more. Emerging markets offered more. Almost anything with a pulse and a yield greater than zero began looking worth a closer look. That outward flow of capital became one of the great hidden support beams of modern finance. This is where the carry trade enters. People like to make the carry trade sound esoteric, but its core logic is wonderfully simple. Borrow where money is cheap. Move that money into something that yields more somewhere else. Hedge what you can. Keep the spread if the structure holds. In the Japanese case, that logic became extraordinarily powerful because the funding side was so cheap for so long. Imagine borrowing in yen when rates are near zero. Now imagine converting into dollars and buying treasuries yielding 4 or 5%, or buying mortgage paper, or buying dividend, paying stocks, or buying broad equity exposure or financing positions elsewhere in the world. At first glance, it looks almost too simple to matter. That is why it became so large. The global financial system is built from repetitive incentives. If a trade works clearly enough, safely enough, and consistently enough, it spreads from one clever desk to an institution, from an institution to a market norm, from a market norm to something the whole world begins depending on without ever admitting that it is depending on it. That is what happened here. The yen carry trade was not just a tactic, it became part of the atmosphere. And once something becomes part of the atmosphere, people stop seeing it. That is always the dangerous stage. A market can survive many visible problems. What it struggles with is the slow removal of a support that had become so normal. Nobody remembered it was temporary. For decades, Japanese capital helped suppress and stabilize the global cost of money. It helped absorb U.S. Treasuries. It helped support mortgage markets. It helped create demand for risk assets all over the world. It helped keep the price of long-dated financial claims friendlier than it otherwise would have been. That matters enormously if you are the United States. The United States has spent many years issuing debt in very large amounts. The federal government is no longer a modest borrower that occasionally visits the market. It is a constant issuer. Treasury supply must be absorbed again and again and again. That absorption depends on demand. And demand is never automatic forever. People like to speak about the Treasury market as though it were guaranteed by the very fact of American importance. The United States is large. Yes. The dollar is central. Yes. Treasuries remain among the most important instruments in the world. Yes. None of that changes the basic truth that bonds still need buyers. Always. And one of the great quiet buyers of the last era was Japan. Not because Japan loved us debt for cultural reasons, because the domestic alternative was so poor for so long. Now think carefully about what happens when that domestic alternative changes. The Bank of Japan begins moving away from the old regime. Rates rise. Yield curve control weakens and then disappears. Domestic Japanese yields, while not suddenly heroic, stop looking like a financial desert. The old assumption that yen funding would be nearly free forever begins to crack. The cost of borrowing in yen rises. The cost of hedging currency risk rises. And the carry trade, which for years had looked almost structurally sensible, begins to look less obvious. That is the beginning of the unwind. Not a collapse in one day, a change in arithmetic. And markets are ultimately ruled by arithmetic, even when people temporarily disguise it with stories. Once the arithmetic changes, capital starts asking different questions. Why am I taking this foreign duration risk? Why am I holding all this overseas exposure? Why am I accepting all this balance sheet complexity when home now offers something more competitive than it used to? That is how repatriation begins. Capital goes home. Not all at once. Not in a way that makes good television just enough to matter. That is one of the most dangerous phrases in finance. Just enough to matter. Because markets do not need every foreign holder of treasuries to dump everything for conditions to tighten. They only need one long-standing source of demand to become less enthusiastic at the margin. That is enough to change price. That is enough to change yields. That is enough to change valuations, mortgage rates, and corporate financing costs. This is why I keep returning to the bond market when other people want to spend all their time analyzing the latest Federal Reserve press conference as if it were sacred theater. The Fed matters, of course it matters, but the Fed does not control the whole game. The central bank has great influence over short rates. It does not command the natural appetite of global capital for long-dated U.S. debt at every moment in history. Long rates are a market price, and market prices can become stubborn. That is the whole problem. The public keeps hearing that if the Fed cuts rates, financial conditions should ease. That can happen. It does not have to happen in the way people assume. If long-term Treasury yields stay elevated because supply remains huge and one of the old structural buyers is less reliable than before, then mortgage rates do not simply drift back to some old comfortable world. Housing remains tight. Refinancing remains weak. Affordability remains broken. The market can stay strained even while the short end gets a little relief. That is what confuses people. They are watching the wrong lever. The housing market is one of the clearest examples. Most Americans live in the world of mortgage rates, not sovereign yield curves. They do not care about a 10-year bond in the abstract. They care about what monthly payment they can afford, whether they can refinance, whether buying a house makes any sense, whether they can move, whether transactions are freezing, and why the promised easing never seems to arrive fully. The answer often sits upstream. Mortgage rates are not determined by hope. They are anchored to the long end. And if the long end stays sticky, because the global demand picture for treasuries is changing, then housing remains more broken than the headlines would like to admit. The same is true in equities, though the path is less obvious to ordinary people. When analysts value businesses, they discount future cash flows. The lower the long-term discount rate, the more valuable distant future earnings appear in today's money. That is why periods of low long rates are so generous to long-duration assets, especially high growth equities. The future is being discounted gently. Raise long rates and the same stream of future earnings suddenly deserves a lower present value. Multiples compress, market narratives change. What looked beautifully priced under one rate regime looks much more demanding under another. This is not a morality play, it is just math. And that math becomes more painful if the old long-end subsidy from Japanese capital is fading. That is why you see markets shake in ways that feel confusing to people who are still using the old script. Earnings may not have collapsed, the companies may still be strong operators, but the rate at which the market discounts the future has changed, and that changes the price people are willing to pay. This is how an invisible plumbing story turns into an everything story. It reaches into housing, it reaches into stocks, it reaches into corporate credit, it reaches into private markets, it reaches into government finance itself. I want to stop there for a moment because government finance is where this becomes especially serious. The United States is issuing debt at a scale that would have looked absurd to earlier generations. Deficits are large, refinancing needs are large, supply is constant. The Treasury market does not need one-time buyers. It needs continuing absorption. If one of the old pools of demand becomes less dependable, yields rise until another buyer is attracted. That is how markets clear. But higher yields are not a harmless adjustment. They increase government interest costs. They tighten private borrowing conditions. They complicate the housing market. They pressure equity valuations. They expose weak balance sheets. They reward strong businesses and punish speculative ones. In other words, they make the financial world more honest. I do not always object to honesty. In fact, I think honesty is healthy after very long periods of easy money. Easy money has a way of flattering weak structures. It keeps bad businesses alive longer than they deserve. It allows leverage to look intelligent. It makes overpaying seem sophisticated. It seduces entire generations into thinking that cheap capital is a permanent natural resource instead of a temporary condition. The world we may be moving into is less flattering. That does not mean opportunity disappears. It means standards rise. That is a very important difference. When long rates stay higher than people hoped, quality matters more. Balance sheet strength matters more. Pricing power matters more. Free cash flow matters more. Duration sensitivity matters more. And the difference between a great business and an expensive hope becomes much harder to ignore. I like that world better than many people do because a more demanding financial environment rewards seriousness. It rewards businesses that can fund themselves sensibly. It rewards owners who do not depend on constant multiple expansion. It rewards people who understand that the price of money matters more than slogans. That brings me to another thing people get wrong. They think the risk here is only Japan itself. It is not. Japan is simply the source of the signal. The real issue is broader. The world spent 30 years enjoying a quiet structural convenience. Cheap Japanese capital flowed out because domestic yields had been crushed. Now that convenience is fading. That is the lesson, not some cartoon story in which Japan suddenly destroys America. The lesson is that one of the old support beams is no longer as generous, as automatic, or as invisible as it used to be when a long-standing support beam weakens. Every asset priced on the assumption of its continued strength must eventually adjust. This is why I think so many people are still underestimating the story. They keep looking for one loud event to blame: a speech, an election, a trade war, a political figure, a bubble bursting in one corner of tech. Those are easy to discuss because they are dramatic. But the world is often changed more by a quiet policy shift in a place most people were not watching. That is what makes this so powerful. Japanese government bonds are not exciting, and yet they may tell you more about the future path of American mortgage rates than long. In financial conditions than half the shouting you hear every day. That is a humbling thought. It should be. Finance is humbling when you study it long enough. It keeps teaching the same lesson in different costumes. The public obsesses over the visible. The real pressure builds inside the hidden structure. Then the structure changes, and everybody suddenly invents new language to explain what was always there. I have always preferred to look at the structure first. That is where the durable insight lives. Now, what would I do with this understanding? I would not panic. Panic is what people do when they discover a truth too late and then try to convert late understanding into dramatic action. I have no use for that. I would do something much simpler. I would stop assuming the old easy world is coming back on schedule. I would respect the long bond more. I would respect balance sheet strength more. I would respect pricing power more. I would be more suspicious of financial structures that require long-term rates to fall quickly in order to look sensible. I would be cautious about fragile duration. I would expect mortgage rates to be less cooperative than the public wants. I would expect periods of market volatility to remain more violent than they looked in the friendlier era. And I would remember that the end of a hidden subsidy often feels like a mystery only to the people who did not know the subsidy existed. That is why I think this matters so much. For 30 years, the world was quietly helped by Japan as domestic monetary dysfunction. Think about how strange that sentence is. One country's long stagnation and rate suppression became part of the global support structure for asset prices elsewhere. That is an extraordinary historical arrangement. It was never likely to last forever. Now it is changing. And when something that large changes, the effects do not remain local. They spread through rates, capital flows, valuations, and expectations. That is the everything story. Not because Japan is dramatic, because it was quietly essential. The market can adapt. It usually does. But it adapts through price, and price is what people feel. They feel it in mortgage payments. They feel it in lower equity multiples. They feel it in harder refinancing. They feel it in the difference between what used to look cheap and what no longer does. That is how this becomes real. If you understand it early enough, it is not a reason for fear. It is a reason for better expectations, and better expectations are a great financial advantage. They keep you from building a life around rates that may not return quickly. They keep you from paying too much for duration. They keep you from expecting easy money to rescue every weak structure. They keep you focused on businesses and assets that can survive under a more honest price of capital. That is where I would want to be. Not because I know every next move in the market. I do not. Nobody worth listening to truly does. But I do know this. When a giant hidden source of global liquidity becomes less generous, the cost of money changes. And once the cost of money changes, everything priced against it must eventually respect that fact. That is the real story. Quiet, boring, hidden in Tokyo, and important enough to shape the American economy more than many of the louder things people cannot stop arguing about.